Behind every major real estate deal, there's a room you're not allowed into. Not yet. On one side of the table sit pension funds, family offices, and institutions that write the checks, representing hundreds of millions of dollars in combined equity. On the other side sits you, the one who contributed almost none of that capital, yet you walk away with more than everyone else at that table combined. This isn't due to a loophole, but because of one crucial clause buried in every deal. A clause most people funding these projects have never thought to question. This is the career that controls that room, every level of it. Level 1, the development analyst. At 22 years old, your job is to understand why things cannot be built, not literally, but practically. Your title is development analyst, and your salary is 72,000 euros at a firm specializing in commercial real estate in a city constantly debating its future architectural identity. Your actual role involves constructing financial models and meticulously organizing documents for senior colleagues in rooms you're not invited to enter. The model is called a pro forma, a financial projection for a project that doesn't yet exist. You estimate the construction costs, the revenue the finished building will generate from rent or sale, and then subtract one from the other. The resulting number dictates whether the project proceeds or is abandoned. Your first pro forma takes 4 days. Your senior associate corrects 17 assumptions and sends it back. You revise it. She corrects 9 more. The third version is finally sent to the director without comment. You quickly learn that in this industry, at your level, the absence of correction is the closest thing to praise. You spend your first 6 months mastering the capital stack, the hierarchy of who provides the money and who gets repaid first. At the top is the bank, providing the construction loan, short-term debt that funds the building process and is repaid first because it carries the least risk. Below the bank is the equity, investors who provide 30 to 40% of the project cost and expect a higher return because they absorb the losses if the project fails. At the very bottom of the stack, taking the most risk and standing to make the most money, is the developer. The developer often contributes as little as 1 to 5% of the total cost. What they contribute instead is the initial idea, the crucial relationships, the specialized expertise, and the years it took to assemble the deal before a single euro of outside capital was committed. You are 23. Your total compensation this year is 85,000 euros. You have built 14 pro formas, and precisely none have led to a project breaking ground. This is entirely normal. Most deals die before they begin. The ones that survive are those where every number in the model withstands contact with reality. Level 2, the associate. At 27, you source your first land deal, and the feeling is nothing like you expected. By now, you hold an MBA, or possess 2 years of analyst experience at a more senior firm, or both. Your base salary is 130,000 euros, and with a good bonus, your total compensation in a strong year reaches approximately 170,000 euros. You are no longer building models for someone else's deal. You are finding the deals that become the models. Sourcing means calling landowners who aren't actively selling, driving through neighborhoods at 7 in the morning to identify parcels, discovering who owns them, and then sitting across from families who have held that land for 40 years. You explain why your offer, which is lower than what they believe their land is worth, accurately reflects what it can support given your development intentions. Most of these conversations lead nowhere. You make 37 calls in your first quarter. 2 call back. 1 isn't serious. The other becomes your first deal. The parcel is a former auto repair shop in a neighborhood the city has zoned for mixed-use development, allowing for apartments and ground floor retail. The city has already expressed a desire for this type of development, which is precisely why you found it. The land is listed at €3, 9 million, but you know the deal isn't viable at that price. You need €3, 3 million. You build two versions of the model, one at each price, and present both to the seller. He counters at €3, 6 million. You close at €3, 5 million. The deal takes 11 months from land closing to entitlement approval. During this period, two other potential parcels collapse before closing. One seller withdraws, and another deal falls apart when interest rates shift enough to disrupt the financing costs, rendering the pro forma unfeasible. You wire back a deposit you spent 3 days trying to justify keeping. Walking away from a deal that doesn't pencil out isn't a failure. It's the discipline that distinguishes those who endure in this industry from those who do not. Level 3. The senior associate. You now operationally own a project. While not financially in any way that puts your name on a deed, it is yours from the moment the land closes to the moment the building opens, and every challenge in between is your responsibility. You are 30. Your base salary is €155,000, and with a bonus, your total compensation reaches approximately €215,000. The project is a 120-unit apartment building in a mid-sized city with a total project cost of €35 million. Your firm's equity in the deal is €8, 8 million. The remainder comes from a construction loan provided by the bank. The first 18 months are dedicated to entitlement, the legal process of convincing the local government that your project adheres to every zoning code, design standard, and community requirement necessary to obtain permission to build. You appear before the City Planning Commission 4 times, presenting traffic studies, facade revisions, and addressing opposition letters from neighboring property owners. During your third appearance, a council member raises concerns about affordability, leading you to spend 6 weeks negotiating a community benefits agreement that commits 5% of units to affordable rents in exchange for approval. On your fourth appearance, the project is approved. The relief lasts for 40 minutes. Then, the construction loan process begins. A construction loan is not a traditional mortgage. The bank does not release the full amount at once. Funds are dispersed in draws as construction progresses, and an inspector is sent before each draw to verify that the work is genuinely complete. This means your relationship with the general contractor is not merely a business arrangement. It's a dependency. If the contractor falls behind, your draw schedule falls behind. If your draw schedule falls behind, your loan accrues interest for longer, and your return diminishes. In month 8, the contractor calls to inform you that steel prices have surged by 14% since the original bid. This isn't a contingency item. It's a significant problem. 3 days are spent on the phone with the contractor, the bank, and your director. The problem is eventually resolved. You don't tell anyone how many hours you spent in your car before it was. The building opens and leases up in 4 months. The annualized return to investors is 17%. Your director sends a one-line email. Good work. You've heard that before, but this time, it resonates differently. Level 4. The Vice President. At 34, you raised your first equity round and, for the first time, truly grasp that development is not a construction business. It is a capital business. Construction is merely what happens after the capital is secured. Your base salary is €205,000, and, with a bonus, your total cash compensation in a strong year reaches around €335,000. Crucially, for the first time, you gain access to the promote, the mechanism that differentiates genuine wealth in this industry from merely a very good salary. Here's how it works. Investors commit equity in exchange for a target return. typically between 8% and 12% per year. They are known as limited partners, passive, writing the check, then waiting. Your firm is the general partner. You find the deal, build the project, and manage every aspect of it. The agreement stipulates that once investors have received their capital back, plus their target return, any profit exceeding that threshold is split disproportionately in the general partner's favor. This excess share is the promote. It is the financial logic that makes development worth the inherent risk. Your first deal as VP is a mixed-use tower in a secondary market. 180 residential units, 1,850 square meters of ground floor retail, with a total project cost of €50 million. You raised €10 million from 3 institutional limited partners over 6 months of meetings, site tours, and model reviews. The largest limited partner is a pension fund that reviews the deal across 3 committee sessions. You present at all 3, answering the same questions about construction risk and exit assumptions with progressively more detail each time. On the morning of the equity close, the wire confirmations arrive, and you sit motionless at your desk. Every deal before this one belonged to your firm. This one, you built from the land acquisition to the capital raise. Your name is on the operating agreement. If this project performs as expected, your personal promote allocation will exceed €1 million. If it fails, investors will lose money, and that conversation will not be one you can delegate. You approve the first construction draw at the end of that week. If you've followed this journey so far, you're exactly the kind of person Economic Awakening is for. Subscribing helps us continue creating this content, and while there's no pressure, we genuinely appreciate it. Level 5. The Managing Director. You now run the entire platform, not just one project, but the entire pipeline. You are 40 years old, overseeing 6 active projects across 3 cities, with a combined project cost of €385 million. Your base salary is €250,000, and with a bonus, your total cash compensation sits around €480,000 in a strong year. The number that truly matters, however, is the promoted interest accumulated across 4 deals nearing their exit. If these projects hit their underwritten returns, your combined promote allocation will exceed €6 million. This is the level where the job transforms entirely. You are no longer the person who knows every minute detail of every project. You are the person who knows the right details at the right moment. You have 7 direct reports, and their performance is your performance. Their mistakes inevitably trace back to you in the form of investor conversations you would rather avoid. One of your VPs brings a deal in a market you haven't worked in before. The land basis is aggressive, commanding a higher price per square meter than comparable properties suggest, because you believe the market is accelerating faster than the data reflects. The model works with your assumptions, but not with consensus assumptions. You approve it, telling her precisely why you approved it and exactly what conditions would lead you to regret that decision. 6 months later, a competing project is announced 3 blocks away. You spend a weekend developing revised scenarios. The deal still works, but the margin is significantly thinner. You call the limited partner before they see it in a market report, walk them through the revised underwriting, and they remain committed to the deal. Your VP learns a profound lesson about transparency and investor trust that no pro forma could have taught her. You don't perceive yourself as one of the country's leading real estate developers, even though that's how you were introduced at an industry conference this quarter. You see yourself as someone exceptionally skilled at managing risk on behalf of people who have entrusted you with capital that is not yours to lose. Level 6. The Principal. At 44, you depart from the firm, not dramatically, but after 3 years of quietly cultivating limited partner relationships, establishing the necessary legal structure, and building the operational infrastructure a platform needs to stand independently. Your managing director says two things when you officially inform him: that you are ready, and that he wishes to co-invest in your first deal. The project that truly established your reputation was a mixed-income tower in a city center that every other developer had passed on. It involved contaminated land, complex air rights, and 3 city agencies with overlapping jurisdiction. You spent 11 months bringing it to closing while still at the firm. You are 46. The tower features 310 units, 3,700 square meters of commercial space, and a ground-level public park the city mandated as part of the entitlement agreement. The total project cost was €105 million. Your former firm committed 8% of the equity, with the rest coming from 2 institutional limited partners and a mezzanine lender, a lender positioned between the bank and the equity in the capital stack, taking on more risk than the bank in exchange for a higher interest rate. The project returned an annualized 23%, well above the 12% hurdle that triggered the promote. Your personal promote was €3, 8 million. The figure didn't alter your life in the way you anticipated. What changed was how other developers looked at you when you entered a room. The deal became a case study in 2 business school programs. The mayor's office called to consult on a transit-oriented development district that would unlock 3 sites you had been monitoring for 2 years. Now, you are building under your own flag. Your first deal is a €44 million industrial residential conversion in a neighborhood that has been post-industrial for 30 years and pre-residential for the last 5. The model underwrites to a 19% return on a 12% hurdle. You have signed a personal guarantee on the construction loan. This means if the project fails, the bank can pursue your personal assets. It's a €4, 3 million guarantee you didn't personally need to sign. Your net worth is substantial enough that most banks would have accepted the entity guarantee alone. You signed it personally because it is your deal. You believe in it with the same conviction you had in every deal that demanded someone take a stand when the easy answer was to pass. The easy answer has never been the one that built anything of significance. There's someone else in this story, a figure you've seen in every room since level 4. He is the one who writes the checks. He is 51 years old. For 19 years, he has been allocating capital to developers from a family office, earning an average of 4% per year. A strong number, one he proudly shares at dinners. What he doesn't mention at those dinners is the closing dinner 3 years ago, where the developer across the table had contributed 8% of the equity, while his family office had contributed 22%. The deal returned 23%. His family office performed well. The developer, through the promote, made €3, 8 million on a deal his family office had funded 3 times over. He had signed promote agreements on 14 deals before that night, but he had never truly felt their impact until that dinner. He had been providing the fuel, while someone else had been driving. And in this industry, the driver, by design, takes more than the fuel provider, because everything you've just witnessed is not a passive activity. It is a career. He isn't angry. He is recalibrating. He sourced his first land parcel 6 months ago. He has appeared before the Planning Commission once, where they requested a revised traffic study. He is 51, and starting at the bottom of a ladder he watched others climb for 2 decades. In any deal, there are 2 kinds of people: the ones who provide the capital and the ones who control what happens to it. The promote exists because those are not the same skill, do not carry the same risk, and do not deserve the same reward. The buildings that define a city's skyline were not built by the people with the most money. They were built by the people willing to put their name on the line for something that did not yet exist. That is the career. That is what it costs.